Have you ever been watching the markets, maybe keeping an eye on your portfolio, and suddenly an asset you're tracking just takes this unexpected, gut-wrenching dip,
Oh, yeah. That feeling.
that immediate jolt of what just happened?
Yeah.
That's exactly where we're kicking things off today. Welcome to the deep dive.
Glad to be here.
So in this deep dive, we're going to unravel a pretty significant recent event in the crypto market. Our mission, really, is to understand the forces behind Bitcoin's big dip below $115,200, and also the broader crypto market's decline. We're pulling insights directly from a recent Times of India article. We want to go beyond just what happened, to really dig into why it happened and what signals the experts are seeing now.
Right. And understanding these rapid market movements and how global economics plays into even really volatile assets like crypto, it offers crucial insights. It shows you how information, sentiment, policy even can just ripple through everything.
Exactly. This deep dive is your shortcut, hopefully, to making sense of these complex dynamics without getting lost in the weeds.
Yeah, we want to give you that shortcut to understanding these connections without you needing a finance degree to follow along.
Okay, so let's talk about that immediate jolt we saw.
Yeah.
What was the headline event, the thing that really grabbed everyone's attention this time, specifically for Bitcoin, maybe?
Well, the big story was definitely Bitcoin, the market leader. It slipped below $115,200. Specifically, it was trading around $115,149. That's a pretty sharp 3% drop.
Right.
But the interesting part isn't just the number, it's that this wasn't some minor blip. It actually triggered really significant liquidations right across the whole crypto market.
Ah,
It kind of revealed this broader risk-off sentiment that seemed to be spreading.
and it wasn't just Bitcoin feeling that pressure, was it? I saw that altcoins, the alternative cryptocurrencies, they mirrored that slide almost instantly.
Yeah, that's right.
XRP and Solana, for instance, both fell over 6%.
Hmm.
And then you had other big names, Dogecoin, Cardano, Hyperliquid, Stellar, Sui, Chainlink, posting even bigger losses, like 7 to 10%. It really was a widespread thing, not just, one corner of the market.
Absolutely. And that really highlights the scale of the fallout. The article points to something quite dramatic. Over $635 million in leveraged positions.
Oh, leverage.
Yeah, basically trades made with borrowed money, they were just wiped out, flushed.
Oh.
And here's the real kicker. Nearly 90% of those hit were long traders.
No one's betting it would go up.
Exactly, the ones betting the price would rise.
Hmm.
CoinGlass reported total crypto market liquidations hit $630.68 million in just 24 hours. Can you imagine being one of those traders? One minute you're feeling confident, the next, poof, your whole position is gone.
Yeah.
That's a brutal reality of a sharp intraday reversal catching so many people off guard.
Okay, so we've laid out this sudden, sharp drop, the cascade of liquidations. Pretty clear picture there, but that's only half the story, right?
Yeah.
Now let's sort of pull back the curtain and try to uncover the why. What were the forces at play here?
Well, the Times of India article pointed to two main culprits, fresh U.S. tariffs and widespread profit-taking. Okay.
Vikram Subbaraj, he's the CEO of Jolt, he stated pretty clearly that Bitcoin slid because of fresh U.S. tariffs and a major profit-taking wave.
Yeah.
So not just one thing, but a combination.
Right, the double whammy.
Exactly.
Mm.
Think about it. Tariffs often signal economic uncertainty, maybe slower global trade. That makes investors kind of shy away from riskier assets like crypto. They start pulling capital out. And then profit-taking is just what it sounds like. Bitcoin had a strong run, so a lot of large holders just decided, okay, time to cash in.
Creates sell pressure.
Huge sell pressure. It just overwhelmed the buying demand at that moment.
And that connects to something I found really intriguing in the piece. They specifically mention Trump tariff jitters.
Mm-hmm.
It's such a stark reminder, isn't it, how these external factors, these global trade policies, can send immediate ripples through markets that seem, totally disconnected, like crypto. This isn't just a crypto story. It really shows how even these digital global markets aren't immune to traditional economic policy shifts. Yeah, it highlights how quickly those macro shifts can puncture the idea that crypto is somehow totally separate. Forces us to rethink those lines.
Okay, but despite that sharp dip, it's important to look for footing, right, to see if there's underlying resilience.
Absolutely crucial. And Vikram Subbaraj's analysis pointed out that the $115,000 level for Bitcoin is a really critical support zone.
Okay.
As long as Bitcoin holds above that level, the thinking is that the broader uptrend is still considered intact. That's a key signal for investors looking for some stability.
That's a really important point about the support level. And looking at the technicals, those heat maps they mentioned, What did they show about where the market pressure points really were?
Yeah, the heat maps, they're interesting. They showed heavy short interest above $120,000.
Meaning people betting it drops from there.
Right. Lots of traders betting on a price drop if it got above that level. And crucially, long liquidation zones below $115,000. That shows you where the pain points were. So if sellers push harder, that $111,000 to $115,000 range becomes absolutely critical. That's the zone for potential bounce backs, like a safety net.
Makes sense.
But what's fascinating here, and Ria Segal pointed this out, is despite that immediate drop, there was a strong long-term signal. Bitcoin actually closed July above $115,000.
Ah, the monthly close.
Yes, its highest monthly close ever. That shows real long-term resilience. It's a critical distinction, you know? A short-term dip doesn't automatically negate a strong underlying trend.
Okay, but wait, it sounds like it's not all doom and gloom here. Even with such a sharp correction, analysts are starting to see some glimmers of optimism, maybe hinting at a rebound.
That's right.
Let's explore those signs, because sometimes the real story kind of emerges after the initial dust settles.
Yep.
What does Ria Segal from Delta Exchange note about the BTC options market?
Yeah, she pointed out some positive shifts there. You know, options let you bet on future price moves. A put-call ratio of 0.65 and visible call buildup between 116K and 120K. Basically, that means more traders are buying call options.
Betting on prices going up.
Exactly, expecting prices to rise in that specific range. And maybe even more telling, the unwinding of puts near 109K, 111K.
So fewer bets on it falling further.
Precisely. It signals that those bearish bets expecting a price fall are being closed out. It suggests maybe a weakening of that bearish sentiment and a subtle shift towards more bullish expectations among traders.
Interesting. And it wasn't just Bitcoin showing some stability, was it? How did Ethereum handle this turbulence? What helped its performance?
Yeah, Ethereum, for example, it dipped briefly to $3,600, but it recovered pretty quickly, back above $3,700.
Right.
And that resilience seems to have been supported by continued retail buying, you know, smaller investors stepping in, but also sustained inflows into spot ETFs.
Ah, the ETFs still bringing money in.
Still bringing money in. Those spot ETFs, they hold the actual crypto, letting traditional investors get exposure easily. They've now topped, get this, $21.85 billion in inflows.
Wow, that's a huge number.
It really is. It's a significant sign of growing confidence, both institutional and retail, in the broader market. And that broader health is always a good sign for the whole ecosystem.
In the CoinSwitch Markets desk, they added another interesting piece here about underlying strength, pointing to Tether's strong Q2 profit, $4.9 billion. What's the significance of that?
Right. They noted that Tether's strong profit highlights growing interest in stablecoins amid improving regulatory clarity in the U.S.
Stablecoins being key for liquidity.
Exactly. They're crucial for market liquidity and stability pegged to assets like the U.S. dollar. So their growing strength, especially with regulators getting maybe a bit clearer in the U.S., it suggests a kind of foundational strengthening of the crypto market's plumbing, let's say.
Okay.
Makes it more appealing, more reliable for bigger players to get involved.
And zooming out a bit, looking at the wider financial landscape, what's the general feeling among analysts like Srivastava at 9 Point Capital? What about institutional confidence, the future outlook?
Well, analysts like Parth Srivastava, they seem to consider Bitcoin to be in a healthy buy-the-dip zone.
Buy the dip. Okay.
Yeah. He suggests that institutional demand is still strong. It continues to absorb supply. Meaning these large financial players are actually stepping in and buying during these price corrections.
Sopping up the sell-off.
Kind of, yeah.
Yeah.
This consistent absorption of supply, he believes, indicates that this current consolidation phase, this sideways movement, is actually expected to lead to a fresh breakout, maybe heading into Q4. It really speaks to a longer-term bullish sentiment, suggesting that despite these short-term jitters, the underlying trend might still point upwards.
Okay, so let's recap this deep dive then. While the crypto market definitely saw a sharp dip, seemingly triggered by those U.S. tariffs and some profit-taking, leading to significant liquidations. A deeper look seems to reveal some underlying resilience. We saw key support levels holding for Bitcoin.
Right.
And there's this cautious optimism fueled by positive signals, like the options market shifts, Ethereum holding steady, and that persistent institutional demand we just talked about.
Yeah, this really illustrates how quickly things like macroeconomic policies, global trade tensions, can just ripple through markets you might think are separate, like crypto. It also shows how critical it is to distinguish between Short-term volatility, which is just part of the game in these markets, and the longer-term trends and the underlying strength of an asset.
Seeing the forest for the trees.
Exactly, even when the immediate view is a bit shaky.
So here's a thought maybe for you, our listeners, to ponder. Given that these big macroeconomic concerns and trade policies can trigger such immediate, strong reactions in these highly digital global markets,
Mm-hmm.
how might this increasing interconnectedness of all our financial systems change the way we define and react to traditional economic indicators in the future?
Interesting question.
Yeah, like what new metrics might emerge as essential for understanding overall market health beyond just, GDP or inflation? Something to think about.